Morning, everyone. Thank you for joining us this morning for the Horson's Spring Tax Update. It's great that you've been able to join us, and I hope that you find this session useful and interesting. When we sort of think about putting on these webinars, we always wonder how much stuff there will be to include, but there always seems to be a lot when we start putting it together. So it's going to be a bit of a whistle-stop tour. We'll cover a lot of things, probably not in very much detail, but if there's anything there which is of interest, then by all means put a question in the chat box, or just follow up with one of us subsequently. So today I'm joined by my colleagues Aaron and Craig, and we'll all be doing part of the presentation. I'll be starting off with business tax, and Aaron will take over, and then Craig finishing off this morning's session. So let's make a start. So can we have the next slide, please? Thank you. So just a bit about Horson's. We're spread across 3 offices: Sheffield, Doncaster, and Northampton. Craig and myself based in Sheffield, and Aaron's down in Northampton. So today I'm going to cover the business tax session, then Aaron's going to do the next 3: national insurance, employment taxes and VAT, and Craig's going to finish off with personal tax and some issues around stamp duty. Thank you. So we're all familiar, I think, with the government support through the furlough scheme, which paid out huge amounts of money to UK businesses during the pandemic. So the Revenue got a bit of a task force looking at those claims, not just furlough claims, but other COVID support. So one of the things they're asking us to do is include information on tax returns about the amount of COVID support claimed, and whether that was overclaimed. I suppose it's really trying to prompt businesses to think about whether they have overclaimed and to make arrangements to refund any amounts which have been overpaid. So that's information we have to include on the corporation tax returns, but also the COVID support for self-employed businesses has to go on income tax returns as well. So just something to be aware of, really. Thank you. So one of the useful things that the government did bring in during COVID was an extension to the loss carryback rules for companies and unincorporated businesses, so sole traders and partnerships. So if those businesses or companies incurred losses in years ending between April 20 and March 22, instead of the normal 1-year loss carryback, there's an extension for an extra 2 years, so 3 years in total. There's a £2 million cap on that, but that's only obviously going to affect the very larger businesses. It's very useful relief, but unfortunately we have found in practice it hasn't actually been dealt with at all promptly by HMRC. So you can make the claims and expect a refund, but it seems to take months and months for the Revenue to actually process those refunds, which is unfortunate because it is a helpful relief to enable companies to get some tax back arising out of losses they may have experienced during COVID. So thank you. Move on. So most people, I'm sure, are aware, it's been announced for a while now that corporation tax rates are going to substantially increase next April. So over a very long period of time, we've seen a reduction in corporation tax rates, sometimes faster, sometimes slower, but generally a downward progression. And then this is kind of changing that on its head, and we're going to have a significant increase. So current corporation tax rate is 19%, which is very low in terms of global economies, and we're going up to 25%, which is still relatively low, but it's not at the opposite, the extreme end anymore. So it'll be interesting to see whether that does encourage businesses to go overseas or just not invest in the UK at all. So obviously something the government's going to be looking at very carefully. Could you just pop back a slide there? Yeah, so in order to protect the smaller businesses, the 19% rate is going to apply on profits up to £50,000. And then between 50,000 and 250,000, you're going to have a marginal rate of 26.5%, so that once your profits are at 250,000, all your profits will just be taxed at 19%. So it's very similar to a mechanism we had a few years ago. And you have to also, it's not just when you look at those profit levels, 50,000, 250,000, you do have to divide the company's profit, well, you have to divide those thresholds by the number of associated companies, so companies under common control. So that's going to make things more complicated going forwards from a corporation tax perspective. Next slide, please. So that will mean that it's worth looking once again at whether dividends are more tax efficient. Generally, in the past few years, owner-managed businesses have paid dividends in preference to salaries or bonuses, and that's generally been more tax efficient. With the increase in corporation tax rates, then bonuses, salary will become more tax efficient. So it's going to be worth crunching those numbers again to make sure you're operating the most tax efficient way. Thank you. So the super deduction, this was introduced last year. So a very generous tax relief on capital expenditure. Get 130% relief on items qualifying for the main pool. So that's most equipment and plant purchases. The 130% relief with a 19% tax rate does give you effectively 25% tax relief on the expenditure, and that's going to be phased out next April. So you have to, in order to benefit from the relief, you have to incur the expenditure before the 31st of March next year. But if you're, quite a complicated rule really, but if your accounting period is not 31st of March, or say it's December, you won't get the full 130% relief. It will be scaled back according to the amount of the period which extends after the 31st of March. So if you have a December year end, you are best getting that expenditure in before 31st December 2022, because you'll get the full relief for that year on the super deduction. If the equipment only qualifies for the special rate pool, then you're generally better claiming the annual investment allowance rather than super deduction. So the annual investment allowance is capped at £1 million. So the items in the special rate pool, which is under the super deduction, you only get 50% tax relief. If you claim the annual investment allowance instead, you get 100% tax relief. So there's quite a bit of planning to do in order to make sure you get the best tax relief, not only when incurring the expenditure, but when we do the corporation tax computations. The super deduction doesn't apply to some assets, so second-hand assets are not eligible, and cars are not eligible, and neither are assets which are leased out. So for hire companies, it's not really a helpful relief, but for many businesses it is very attractive. So going on to the annual investment allowance, that's been around for quite a few years now. So that's 100% tax relief on the year of expenditure. The amount, or the cap on the allowance, has varied from year to year. At the moment it's £1 million, so it's all very generous, but that is supposed to come down to 200,000 next March, although it's quite possible there could be some changes before we get there. There are some complicated rules if your period spans that 31st of March date, and the annual investment allowance drops at that point. Not much to say about free ports at the moment, although they have been identified, one in Hull, another one at East Midlands Airport. They're not really in operational at this time, so it's one to catch up with a bit later, I think. So one of the things that the Chancellor did mention in his spring statement was that he was going to look at capital allowances and tax relief basically on capital expenditure. So although we have these generous reliefs at the moment, the super deduction, the annual investment allowance, it is all quite complicated. And if you don't qualify for those additional reliefs, the underlying rate of tax relief on capital expenditure, which is just 18%, isn't very generous. So there is some work the Chancellor's identified at looking at how that can be made more attractive, really. And maybe we'll get some simplification, who knows now. So that's going one to watch. Research and development, this is obviously a big area. It's very generous tax relief for companies which incur expenditure on research and development. In the last few years, we've seen a lot of companies just offering R&D services, and claims have got the volume of claims has much increased. I think that's caused the revenue some concerns. We are seeing some cases now appearing before the tribunals where the revenue think the reliefs are being claimed incorrectly. So I think HMRC are just trying to make sure the relief is properly targeted and claimed only when it should be claimed. So some of this has been brought in, some restrictions. So for loss-making companies, there are some restrictions now which have been brought in. So you can see that top bullet point, the cap introduced in April 21. And then there's also some things which are sort of up for consultation. So they're things like claims only being able to be made digitally, ensuring there's a full supporting information provided with the claim to HMRC. Because at the moment, although most people do submit supporting information, you don't have to. And making sure those claims are signed off by a senior person in the company to make sure that the company is aware of what's going in the claim and is comfortable with it. So we're waiting to see what happens on those. Another area which they're looking to crack down on or restrict is tax relief for expenditure incurred on research and development incurred overseas. So they're trying to focus it on UK expenditure. But again, that's not, that's a thing not been coming in for a little while yet, but one to watch. Next slide, please. So we've got some slight improvements to the cultural tax reliefs coming in. That's pretty limited scope, but we do see that for theatres, particularly making claims there. And we've got this new tax. It does seem like the government loves to introduce new taxes all the time, but we've got a new tax for residential property developers, and this is to try and recover some money in order to the cladding issues around the Grenfell fire. So it's only on the very largest property developers, so it's only if your profits exceed 25 million, but a 4% tax charge. So that's obviously going to affect some of our very largest businesses in the country. Thank you. So I'm going to hand over to Aaron now to take us through some issues around national insurance and employment taxes. So thank you, Aaron.
Morning, everyone. Yeah. Okay, so I think given the vast amounts spent by the government on COVID measures, that sort of left them in a position of having to find ways to balance the books. And unfortunately, this has resulted in a 1.25% increase to national insurance with effect from 6th of April 22. So this is going to affect employer and employee Class 1 national insurance, as well as the Class 4 payable by the self-employed. Owner managers that remunerate themselves via dividends don't escape either, because they've actually increased the dividend tax rate across all bands by 1.25%. From April 23, this is going to be rebranded as the Health and Social Care Levy and charged as a separate tax of 1.25%. So NI will then return to its original levels. This has got some interesting implications for pensioners, because whilst this is charged as an increase to NI in 22-23, pensioners who are employed or self-employed aren't actually affected because NI is not charged on people of state pension age. However, when this is rebranded as the Health and Social Care Levy, it will affect pensioners that are employed and self-employed, and they will be required to pay it. In terms of how the levy will be collected, employees it will be collected via the PAYE system, whilst for the self-employed it will be collected via their self-assessment tax returns. The government had asked employers to display a political message on the payslip stating that the increase was to fund social care. But just to be clear, that's not compulsory for people to do that. Although some employers may acquire software where that message has been hard coded and they might not be able to remove it. Next slide, please, Rob. Okay, so whilst the 1.25% increase was not really welcomed, there was a little bit of good news in the spring statement in that the primary employee class 1 NI threshold, which was originally set at 9,880, is actually going to increase to 12,570 per annum. However, as this is a transitional year, the threshold will be apportioned. So it can be 11,908 for 22-23. So when that transition comes into effect in July 22, there's going to be a bit of payroll chaos, I think, as payroll teams sort of adjust to that new rate. And it's also going to impact on directors' annual earnings period calculations for NI as well, so bear that in mind. Employee NI above that primary threshold is going to be charged at 13.25%, previously 12%, so we can see the impact of the additional 1.25. And for earnings over 50,270, it's going to be charged at 3.25%, whereas it was previously 2%. The employer NIC threshold will remain at 9,100, so no increase to that. And above that, employer NI is going to be charged at 15.05%, whereas it was previously 13.8%. Next slide, please. There was some good news for employers. So the employment allowance for employer NI purposes is being increased from 4,000 to 5,000 from April 22. So employers will get an additional £1,000 off their employer NI bill. But just to be clear, that doesn't apply to larger companies with an employer NI bill of over 100,000. It also doesn't apply to companies where there's only one employee paid above the employer NI threshold who is also a director. Self-employed people are also going to benefit in respect of an increase to the lower threshold for class 4 NI. And we see that increasing from 9,880 to 12,570 with effect from 6th of July 22. But again, that limit's going to be apportioned for 22-23, so it's actually going to be 11,908 for the whole year. Class 4 is then going to be charged at 10.25% on profits between 11,908 and 50,270, whereas that was previously charged at 9%, and 3.25% on profits over 50,270. The Class 2 small earnings threshold is also going to increase from 6,725 to 12,570. So overall, some mixed news on the NI front there. Move on, please. So moving on to employment tax. So the pandemic saw various relaxations made for employees to the rules in respect of use of home claims and claims for the cost of equipment used for home working. So in terms of equipment, the strict position is that the equipment should be necessarily required for home working and that any private use must be insignificant. This was relaxed for 2020 and the 2021 and 21-22 tax years, such that an employee could claim back the equipment cost on a tax-free basis from their employer, provided the sole purpose was to allow home working during COVID. However, this relaxation has ended with effect from 6th of April 22, and so we're back to that original strict position where the equipment has to be necessarily required for home working. In terms of use of home, just go back a slide, please, Rob. In terms of use of home, the strict position is that you must be required to work at home by your employer under home working arrangements to claim back the costs of working from home. And in this regard, you can claim back a flat rate of £6 for each week you work at home without having to provide evidence. But broadly speaking, this covers light, heat, water and telephone calls. The alternative is to claim the actual additional cost of working from home using an apportionment, but you have to have evidence of that to support that apportionment claim. And in a lot of cases, it doesn't end up being that much different to the £6 per week, to be honest. A concession was introduced for use of home claims during the pandemic, whereby HMRC would give the £6 per week for the whole year, as long as you were mandated by your employer to work from home due to COVID at some point during the year. However, that concession's ended with effect from 6th of April 22. So you do now need to be working at home under home working arrangements in order to claim that. There was also a relaxation to the cycle to work scheme during the pandemic. So the cycle to work scheme basically allows the tax-free use of employer provided bikes where they're mainly used for qualifying sort of home to work journeys. But the qualifying journeys rule was relaxed for the pandemic because people working from home. Now that rule has basically ended from 6th of April 22, so back to the strict sort of position. Okay. Moving on to electric cars, so I think for a number of years the government's been trying to incentivise people to use electric cars as part of its environmental drive. And in this regard, the benefit in kind on employer provided electric cars is just 2% of the list price. It's also beneficial for a company to acquire electric cars from a corporation tax point of view, because there's a 100% capital allowance in the year of acquisition, provided it's a brand new car. Moreover, if a company acquired an electric van, then potentially there's a 130% super deduction to claim, which is even more beneficial. Capital allowances are, of course, clawed back when the car's sold, but if the company's buying another new electric car broadly, there'll be a sort of net off there. In terms of benefits in kind on the provision of fuel, then if an employer installs electric car charging points at the office or wherever, then employees can use those electric car charging points to charge the cars, and it's not actually a taxable benefit in kind. It doesn't trigger a fuel benefit, and that's because electricity is not a fuel for these purposes, which is pretty good news. If the employee does have to incur the cost of charging their car themselves, so if they charge it at home or at some other sort of charging station, then they can claim 5p per business mile on that. If the employee actually owns the car themselves and it's an electric car, then they can actually claim 45p a mile on the first 10,000 business miles and 25p thereafter. Next slide, please. Moving on to company vans, similar situation, government's trying to encourage people to use zero emission vans. So if you do provide a zero emission van to an employee, then there's no taxable benefit in kind on that. If you don't, then there's basically a flat rate van benefit for 22, 23 or 3,600. And if they've got fuel for private use, then there'll be a flat fuel benefit charge of £688. When employers are providing vans to employees, they do need to be mindful of the Coca-Cola case, where basically this concerned vans that have been modified. So what happened is Coca-Cola provided Volkswagen Combi vans to some of their employees, and they essentially had 3 compartments. So the first compartment, obviously, for the driver, and there was a compartment behind with some seats for some passengers, and then behind that there was a sort of a bulkhead, and then behind that a third kind of compartment which was for the carrying of goods. So this has gone through all the upper tier tax tribunal and to the Court of Appeal, and Coca-Cola lost at every stage. Basically, the Court of Appeal have ruled that those Volkswagen Combi vans are not vans for the purposes of the tax legislation, because they weren't primarily designed to carry goods or burdens because of the way they'd been modified. It's unclear exactly whether Coca-Cola will get leave to appeal to the Supreme Court. It's been looking into that to see what the situation is, and it's all a bit unclear as to what's going on that at the moment. So it's a bit of a case of watching this space, but I think, you know, if you are providing vans to employees, you do need to be mindful of that case, because the difference between treating, you know, the vehicle as a van or a car is quite large, with the car benefit charges being a lot more steep than the flat rate van benefit charges. Okay. So moving on to IR35. So from April 21, large and medium-sized businesses became responsible for determining the employment status of workers who are providing their services via a personal service company. And where the worker is found to be an employee, then the large medium business is supposed to apply PAYE and NI on the payments made to that personal service company. I mean, prior to that, the onus was on the personal service company itself to make that determination and account for any PAYE or NIC. Initially, HMRC had applied a soft landing period for the first year, under which it wouldn't raise penalties for errors in applying those new rules. So that soft landing period has now ended. So if you are a large or medium business that's employing personal service companies to do work for you, you do need to be careful when you're applying those rules. Please. Now, moving on to VAT, making tax digital for VAT. So this requires businesses to maintain records in an electronic format and to prepare and submit the returns from these records using functional compatible software. So when making tax digital for VAT was introduced in April 19, it was only compulsory for businesses with turnover in excess of the 85,000 threshold. But there are a lot of businesses that are voluntarily registered with turnover under the threshold. So what's changed from April 22 is that all businesses, irrespective of turnover, now have to apply making tax digital for VAT purposes. We're also seeing the introduction of a new penalty regime for VAT from January 23. We're now moving to a points-based system whereby you incur a point for each late submission, and where points reach a certain threshold, then penalties will be charged. And the thresholds depend on whether you submit quarterly, annual or monthly VAT returns. So the submission frequency penalty threshold for each type of submission frequency. So for annual returns, its threshold's 2 points. Quarterly returns, it's 4 points, and for monthly returns, it's 5 points. So if you reach that threshold, then a £200 penalty will be applied. And basically, those points stay on your record for 2 years and will only come off if you've got, a completely clean record for that period. We've also got a new late payment penalty regime coming in as well. So basically, if you pay your VAT late, then effectively, if the payment is made 16 to 30 days after the due date, then you get a late payment penalty of 2% of the VAT unpaid. And if it's still not paid after 30 days, then there's additional 4% levied on top of that. So please bear that in mind when that comes in January. Next slide, please. Okay, so sort of sticking with some of the environmental themes we're seeing from the government, they're trying to incentivise people to install energy-saving materials in their homes, and they're doing that by reducing the VAT rate on qualifying materials to 0% from 5%, and that's going to last until March 27. Examples of energy-saving materials include rooftop solar panels, heat pumps, and insulation. So that's good news, provided, of course, that people providing those do actually pass that on to customers. Okay, now moving on to personal tax, and I'm going to hand you over to Craig Walker. Thank you.
Thanks, Aaron. So yes, I'd like to talk about personal tax and then move on to a few issues affecting stamp duty, land tax. But yeah, first of all, looking at personal tax and some of the recent changes. So the Chancellor announced last year that there will be a number of freezers to personal tax allowances. So typically tax allowances increase each year with inflation. So he went against the norm last year by saying that he would freeze some of the allowances. So we've seen the personal allowance being frozen at 12,570, not only for 1 year but for 5 years. So at least we've got some certainty as to what it's going to be going forward. That will mean that around 1.5 million more people will pay income tax. So that's going to have quite an impact, and obviously increase the tax take for the Chancellor. The other thing he announced as well is that the higher rate tax threshold will be frozen at £50,270. Again, not just for 1 or 2 years, but for 5 years. So again, that's going to increase the amount of tax take that the Chancellor is receiving. It's estimated that around 1.2 million additional people will fall within the higher rate tax bracket as a result of that. So I think the Chancellor had limited options, really. He wasn't able to increase the rates of income tax because in the Conservative Party manifesto, they promised not to increase the rates of income tax. But clearly he needed to do something to try and increase the tax take. So what we've got instead is this stealth tax, if you like, by freezing the allowances. So that was originally expected to raise about £8 billion, £8 billion. But because of rising inflation, we're now told that it's expected to raise about £21 billion, so about 2.5 times what it was originally forecast to bring in. Moving on to the next slide. So there was a big surprise in the spring statements. I don't think many people saw this coming prior to the spring statement. That the Chancellor announced that the basic rate of income tax would be cut from 19% to, sorry, from 20% to 19%. It's not going to be done immediately. He said it would be from April 2024. And he also added a few caveats. He said that this is dependent on basically the economy doing well, and giving him scope to introduce this tax cut. So we'll have to wait and see whether it does actually come in. Interestingly, the next general election is expected to be in 2024. So yeah, call me a cynic, but perhaps the timing is linked to the general election. So yeah, that was a massive surprise in the spring statements. And then we were sort of thinking about the implications of this in terms of tax reliefs. So obviously the basic rate of income tax is being cut. What impact might that have on the tax reliefs available? So first of all, if we think about tax relief available on gift aid donations, charitable gift aid donations. So at the moment, for every £80 that you donate to a charity, the government top that up. They give £20, and that is linked to the basic rate of tax being 20%. But clearly, if the rate is dropping to 19%, there was some uncertainty about how that would work and whether that would impact the rate of relief. So the government have come out and said that gift aid will be unaffected until at least 2027. So you will still get the 20% relief on charitable gift aid donations. As to what's going to happen beyond that, we don't know. Interestingly, they've not made any comments yet in terms of the impact it might have on pension contributions. So at the moment, if you put £80 into your pension pot, the government top that up by a further £20. Again, that is linked to the basic rate of tax being 20%. So we at the moment we expect that, given that the basic rate is falling to 19%, you will only get tax relief at 19% from 2024 on pension contributions. So that's certainly not a simplification, and so we'll have to wait and see what the details say about that. For higher rate taxpayers, that they can claim additional relief, obviously via their tax return or via their tax code. So they should be able to get another 21% relief via their tax return. But interestingly, even though the basic rate of income tax is being cut, it's not affecting the rate of tax being charged on dividends. The basic rate of tax on dividends will remain at 8.75% despite this change. If we just pull up the next slide, you'll see the rates of dividend, rates of tax on dividend at the moment. So I think as Aaron mentioned earlier, the tax rates for dividends were increased in April across the board by a 1.25% increase. So the basic rate tax due on dividends is now 8.75%, 33.75% for high rates, etc. But let's not forget that the first £2,000 of dividend income is taxed at 0%. So provided your total dividend income is below £2,000, you've got no tax to pay on that. So that 1.25% increase is in line with the health and social care levy. So I think Aaron mentioned earlier about VAT and about a new penalty regime being introduced for VAT purposes. So I think the revenue like to introduce things for VAT first, try it out for VAT, and then if it works, roll it out for income tax purposes. So I think that's what we'll see with this new penalty regime. It's coming in for VAT purposes from January 23, and then for income tax purposes, it will be introduced from April 24. So we've got some time before it comes in for income tax purposes. It was originally meant to be April 23, and then they've delayed the implementation. And as Aaron mentioned, this is a points-based penalty regime. So I won't go into the details, but that's coming in April 24. Initially for people with business or property income above £10,000, and then from April 25 it will be rolled out for all income tax payers across the board. So we've got that to look forward to in April 24. What else is happening in April 24? Well, again, Aaron talked about making tax digital for VAT purposes. That's coming in for income tax purposes from April 24, which will be a massive change to the personal tax regime, probably the biggest change since self-assessment was introduced. So we've got some time to plan for this. So it doesn't come until April 24, and we're still waiting for the final details to be released. But we understand that if you have business income or property income above £10,000, then you will be within the Making Tax Digital regime from April 2024. That will mean that you will need to keep your business or property records in a digital format, which you may be doing already. And also you will be required to, and this is the big change, you will be required to submit quarterly returns to HMRC, plus an end of year submission as well. So effectively five submissions during the year. So that's clearly a big change to the personal tax regime. I should just flag up that at the moment, the revenue aren't intending to change the timing of tax payments. So the tax will still be due on the same dates. So if you make payments on account, you will pay those in January and July. But who knows in the future what will happen with the payment dates. We could see HMRC require taxpayers to pay quarterly. But at the moment, they're saying that's not going to be the case. So moving on to capital gains tax. So I think last year, prior to the 2021 budget, there was a lot of speculation about potential changes to capital gains tax. So we were all watching the budget with interest, expecting there to be perhaps an increase to the rates of capital gains tax. That didn't happen. It didn't happen last year. It didn't happen in the spring statement this year. That's not to say it's not going to happen. I think we have to just watch this space. There could be an announcement later this year in the budget. But clearly, so there's been lots of speculation in the past about aligning capital gains tax rates with income tax rates, and that could still happen. So it's something to watch out for. I mentioned before about allowances being frozen. This applies also to the annual exemption for capital gains tax. So that's been frozen at £12,300 until April 2026. So yeah, lots of freezing of allowances. And this 60-day rule. So this was announced last October. But I think there's a lack of awareness about this rule, so I really want to just flag up this particular change. So if you dispose of a UK residential property, there is a requirement to report that disposal to HMRC within 60 days. That used to be 30 days up until October 21, but you've now got 60 days to report that disposal. You've also got to pay the capital gains tax due on that disposal within 60 days. So they've extended the deadline from 30 days to 60 days, but it's still quite a tight deadline. That applies to UK residential property. However, there are some exemptions. So if you sell your main home and there's no and the gain is covered in full by private residence relief, then you don't need to report it within 60 days. Similarly, if you make a loss on the property disposal, or if the gain is covered by your annual exemption, the 12,300, then you don't need to report within 60 days. So it's something to be aware of, something to make sure your clients are aware of if you're in that particular industry. So it's certainly a welcome change from 30 days to 60 days, and it's a common sense relaxation, I think. So moving on to inheritance tax. So the theme of the day, I think, is frozen tax allowances, and that applies to inheritance tax also. So the nil rate band for inheritance tax is still 325,000. So if your estate is worth less than 325,000, you will have no inheritance tax exposure. It's been this rate since April 2009, which is quite staggering, really. If you think back to 2009, Gordon Brown was the Prime Minister. I think a lot of time has passed since then. House prices have increased significantly, yet the nil rate band has remained at 325,000. So clearly, more and more estates are going to get caught within the IHT net, and I guess it just means that it's even more important now to think about IHT planning and trying to minimise your IHT exposure. Some people are able to claim the residence nil rate band, which basically tops up your nil rate band to £500,000 potentially. But there are conditions attached to that, which I won't go into today. But broadly, you've got to leave your property, leave your home to a lineal descendant. So it's a case of checking to see whether the will provides for that or not. There was a simplification to the IHT rules that was introduced in January, which basically means that a large number of low value estates no longer need to complete IHT forms. So that's a welcome simplification. So that came in January this year. And just finally, looking at pensions, again, there's been another freezing of the limits. So the lifetime limit for pensions has been frozen, and that will be in place until April 26. So the final section today is on stamp duty land tax. So you may recall that during the COVID pandemic, the government wanted to stimulate the property market. So it reduced the nil rate band for stamp duty land tax. It increased it, not reduced it. Increased it from the normal rate of £125,000 up to £500,000. So that came in July 2020. So if you bought a property around that time, so 2020, 2021, you could have potentially saved up to £15,000 in stamp duty. So that was massive saving to some people. That was then reduced from £500,000 down to £250,000 in July 2020, and then since September 21, it's come down back to the original threshold of £125,000. So it's back to how we were really in terms of stamp duty land tax. So we're now down to this 125 threshold. Just moving on to a couple of other issues affecting stamp duty land tax. So the revenue believe that there are people out there abusing the stamp duty land tax rules, particularly in relation to the disposal of mixed-use properties. So mixed-use property, we're looking here at properties with both residential and non-residential use. So it may be a house with some some non-residential land attached to it. So traditionally, it's been traditionally, if you have a mixed-use property, you would pay tax at the non-residential rates. You pay stamp duty land tax at the non-residential rates, which are typically lower than the residential rates of stamp duty land tax. So HMRC think that people are trying to be clever here and you know, structure the transaction so that you pay tax at the lower rate. So what we've seen here is a HMRC consultation into mixed-use properties. That they're looking at the method of calculating stamp duty, and we could well see some changes being announced in the coming weeks and months relating to this. We're expecting perhaps an apportionment method of calculating stamp duty, where you would pay residential rates of tax on the residential elements, and you would pay stamp duty at the non-residential rates on the non-residential elements of the property. So we'll wait to see what happens there. They're also consulting on multiple dwellings relief. So in the past, it's been possible to buy multiple dwellings in one transaction and claim this relief to pay less stamp duty land tax. HMRC think that there's some abuse of the rules here. So again, they're looking at perhaps tweaking the rules. So we're looking here at cases where perhaps you're buying a house with a separate granny annex, and trying to treat that as the purchase of two dwellings rather than just one dwelling. So if that is relevant to you, then something to certainly watch out for. We could see some rule changes coming in the next few weeks and months. And just finally on stamp duty land tax, if you are a non-resident purchasing residential property in the UK, you will pay a 2% surcharge. A 2% surcharge that came in last April. So if you have any clients who are non-resident, that they could be affected by that particular change. So that brings our presentation to a conclusion. But we've certainly got some time left today. If anyone has any questions, if you'd like to pop them in the chat box now, and we'll do our best to answer them. Or if not, our contact details are up on the screen there. So if you'd like to email us or phone us after the session today, we'll be more than happy to discuss any tax issues that you may have. So we'll just wait to see if any questions pop up in the chat box. Don't appear to have any. Oh, sorry. Do you offer tax planning for inheritance tax? We do offer tax planning for inheritance tax. Yes, we do. We work with Horson's Wealth Management to provide inheritance tax planning. So yeah, that's certainly something we can help with. Any other questions? No. Okay. If there's no more questions, then I think we'll leave it there. But yeah, thank you again for joining us today for the update. Hope you found it useful. Appreciate it was a whistle-stop tour. Yeah, and if you have any questions, then feel free to get in touch with us. Thank you very much.